Everyone, and welcome to a brand new explainer right here on the GAAP Advisors Ind AS Clinic YouTube channel. I'm absolutely thrilled you're tuning in today. In this explainer, we're going to unpack a super fascinating real-world case study. It's about this tiny, seemingly insignificant detail that, actually results in a massive compliance failure. We're talking about the absolutely crucial importance of cross-referencing in financial statements. So whether you're the one preparing these statements, auditing them, or maybe analyzing them for investments, this is a must-know concept that honestly just slips right through the cracks way too often. Before we dive into the meat of our analysis, let's quickly lay down some ground rules for this session. Just to be clear, the functional and presentation currency we're discussing is the Indian rupee, so any other currency is considered foreign. Our reporting period runs from April 1st to March 31st. And hey, while our response is framed under the Ind AS framework, there is literally no difference between Ind AS and IFRS for the topic we're tackling today. So you can absolutely apply this discussion if you're following the IFRS framework. Oh, and one quick mandatory disclaimer. The views expressed here are the personal views of the author and aren't binding on the audience. We definitely request that you seek the help of an expert before taking or refraining from any action based on what we discussed today.
All right, so here's our roadmap for today's explainer. First, reviewing the financial statements. Second, the rules of cross-referencing. Third, the risk of obscured information. Fourth, resources from GAAP advisors. And finally, conclusion and next steps. Let's jump right in.
Section 1. Reviewing the financial statements.
Okay, so take a look at this snapshot. This is the Other Equity section pulled straight from a statement of changes in equity. And this observation actually comes from the published Ind AS financial statements of a listed company. It was independently reviewed by GAAP advisors on a suo motu basis, meaning GAAP advisors basically took it upon themselves to check this for compliance. Now look closely at those columns. General reserve, capital reserve, retained earnings. It looks like a completely standard professional financial statement, right? But there's a hidden flaw in there.
I want you to put your auditor hat on for just a second here. Look specifically at that line item highlighted in yellow. It says effective change in accounting policies and shows a negative 12,517.92 million rupees sitting right there in retained earnings. Okay, have you spotted what's missing yet? There's absolutely no note number next to it. Zero. No cross-reference whatsoever pointing the reader to the details of this massive change. Now you might be wondering, why does this even matter? Well, let's see what the standards actually say.
Section 2. The rules of cross-referencing.
So, this brilliantly illustrates the absolute mandate laid out by the law itself. This right here is Clause 422 of the General Instructions for Preparation of Financial Statements under Division 3 of Schedule 3 to the Companies Act 2013. And it clearly says, each item on the face of the balance sheet, statement of changes in equity, and statement of profit and loss shall be cross-referenced to any related information in the notes. Notice how it doesn't say you should do this if you just happen to have the time. No, it is a hard shout. You've got to maintain this delicate balance between excessive detail and too much aggregation, and cross-referencing, that's the vital bridge, making that balance possible. And this isn't just some local legal requirement. It's deeply embedded in the accounting standards themselves. Paragraph 113 of Ind AS 1, Presentation of Financial Statements, echoes this almost exactly. It requires entities to present notes systematically to make sure everything is understandable and comparable. And it repeats that exact strict requirement. And entities shall cross-reference each item to any related information in the notes. And remember those ground rules we talked about earlier? Because of parity, this exact same systematic presentation and cross-referencing rule applies under IFRS too. So if you're failing to do this, you are straight up failing to comply with Ind AS 1.
Section 3. The risk of obscured information.
All right, looking back at our statement, the company presented that line item, effective change in accounting policies, totally without a cross-reference. Now, Ind AS 8 strictly requires specific, really detailed disclosures whenever you change an accounting policy. So imagine you're a user of this financial statement. You see this 12 billion rupee adjustment, and you immediately think, wait, why? But without a note number, where are you supposed to look? You're basically left blindly hunting through this massive annual report, just hoping to stumble upon the corresponding narrative. The info might technically be somewhere in the document, but it's completely disconnected.
So here's the really crucial part: how the standards actually define this kind of failure. Paragraph 7 of Ind AS 1 gives us the exact definition of obscuring information. Basically, information is obscured if it's communicated in a way that has the exact same effect on a user as just leaving it out entirely. Examples of this are using vague language, inappropriate aggregation, or burying things under a mountain of immaterial data. But take a look at bullet point 2. Information is scattered throughout the financial statements. By failing to provide that simple, tiny cross-reference, the company has effectively scattered the data. And because of that, the company has presented its statement of changes in equity in an obscuring manner, failing the most fundamental test of understandability.
Section 4. Resources from GAAP advisors.
As you can see, a literally tiny oversight can snowball into a major non-compliance issue. So how do we actually prevent this? Well, if you're dealing with complex accounting scenarios, you really need to head over to gapadvisors.com. Their issue repository hosts over 4,500 issues and detailed responses on Indian accounting standards and Indian GAAP. And honestly, the best part? Anybody can register for completely free. Once you're in, you can submit your own issues on Ind AS and Indian GAAP, and boom, a detailed response is delivered straight to the inbox of your registered email. It is unbelievably useful, especially for auditors who need to rigorously document exactly how they addressed Ind AS applications in their audit files.
Plus, remember how I mentioned earlier that today's observation came from a suo motu review? Well, you don't actually have to wait around to be independently reviewed like that. You can be proactive and get your financial statements reviewed by GAAP advisors before you even sign them. All you do is prepare your statements in a near-to-publishing PDF format and email them over to info@gapadvisors.com. If you're an auditor, this is a fantastic way to protect your signature. Or, hey, if you happen to invest in listed company shares, getting a review of a company's financial statements for Ind AS compliance can seriously help you make a proper, fully informed decision on whether to buy, hold, or sell those shares.
I also really want to point out that the specific observation we're unpacking in this explainer was originally featured in the 214th edition of the GAAP Advisors Task Weekly newsletter. This is a fantastic newsletter authored by CA Manish C. Iyer, Director of GAAP Advisors, and it's published right on LinkedIn. To date, there are over 230 editions published, and they are just packed with insights exactly like the one we covered today. So if you're on LinkedIn, I highly encourage you to go find it and subscribe to the newsletter for free.
And of course, if you've got a highly specific, super complex issue that needs some deep, personalized attention, you have direct access to expertise. You can actually book a one-on-one consultation regarding your Ind AS and IFRS issues directly with the author. Just head over to his page on topmate.io and get your unique accounting challenges completely resolved.
Section 5. Conclusion and Next Steps.
If you enjoyed this breakdown, but maybe you want to listen on the go, or you just want an even deeper dive into the specific observation we dealt with in this explainer, I highly recommend checking out the audio format. Just ask your smart speaker or use your phone to connect to the GAAP Advisors Ind AS Clinic podcast. It's readily available for you on Spotify, Amazon Music, and of course, right here on YouTube.
Well, that brings us to the end of our explainer. I want to sincerely thank you for giving us your time and focus today. If you found this breakdown valuable, please go ahead and hit that like button, add your thoughts or questions in the comments, and absolutely make sure you subscribe to the GAAP Advisors Ind AS Clinic channel if you haven't already. And please, share this explainer among your contacts, your colleagues, your audit and finance teams, and especially among any students pursuing their CA course, so we can keep spreading the knowledge of Indian accounting standards. I'll leave you with this final thought. If a simple missing number can hide 12 billion rupees of context, what else might be hiding in plain sight in your financial statements? Think about it. Thanks again, and we'll see you in the next explainer.